So for the longest time, guys, I've had this little mystery blue book on my desk, and today I decided to actually read it. Now, it turns out that this book promised me something that I honestly call BS on, and it showed me a formula to actually let a computer pick my investments for me and basically say, hey Tommy, these investments are actually going to beat the market. Now, when I heard this, like any normal person, I said, if this is this easy, why isn't everyone out there actually doing it? And then the author went ahead and broke every piece of information down. So much so, I read this entire book in around 2.5 hours. I'm a slow reader, so you can probably read it a lot faster. But overall, he said a few things. The magic formula only has two pieces of information. A sixth grader can understand it. And on top of that, it's very simple to actually follow. And then I said, who the heck is this guy to tell me what to do with my money or talk to me about some magic formula? Like a magic formula? Like really? Like what is this, tooth fairy? So then he breaks everything down. He says, hey, I teach at an Ivy League school. Okay, cool stuff. I actually am a manager at a capital fund, and we've made around 40% annualized since 1985. Now, that's where things got interesting. And he says, hey, if you followed this magic formula, by the way, here's the picture right here with the stats, you would have made around 30.8% on your money in 17 years instead of 12.4% with the S&P 500. Now that's from 1988 to around 2004. Now, obviously, I'm not gonna talk about compound interest. That's boring. Talk about like, hey, if you invested 10,000, this money made more money, so meaning next year you'll make more money. That's compound interest. That's boring. So I won't bore you with the fact that basically, if you invested this $10,000 and you made 30.8% on it for 17 years, it would have turned into $960,000 instead of a measly $72,000 with the S&P 500 12.4% return. That's the crazy idea. So in this video right here, I'm gonna break down the secrets of this mystery blue book I got on my desk here, the formula, how it works step by step, and also what my thoughts actually are on this formula. And now I'm gonna switch, for example, my entire retirement plan because of this little book that allows me to use a computer, by the way, for free, to tell me exactly what stocks to pick. This is crazy, but it's real. As always, guys, do me a favor. If you're interested, smash the like button. And on top of that, also join the family by subscribing to the channel and hitting the bell and getting notified. Now, the first thing I want to say, guys, when I read this book, honestly, I was super negative because in reality, I just call BS. Anything that sounds too good to be true, most of the time I'm like, hey, this sounds too good to be true and I don't want to get scammed, right? But when you really think about it, everyone has a secret formula or, for example, a secret strategy. Let's call it that, okay? Warren Buffett has the idea that, hey, if you buy a great business at a fair price, you're gonna make money. Benjamin Graham had the idea that if you buy a terrible or a good business for less than its liquidation value, you're gonna make money. Peter Lynch had the idea if you buy a company that you well know and it has a good financial story and you break everything down, you're gonna make money. John C. Bogle had the idea that forget all that and just invest your money into an index fund and let it do all the work. And then TommyBryson, the guy you're looking at right here, my idea was just basically, hey, yeah, buy the index funds or the ETFs that track the indexes and just do dollar cost average, rebalance every now and then, and you'll be good to go. It's average, but compound interest is going to give you a wonderful surprise in the end. And the author of this little blue book has also his formula, his little secret sauce to actually make a lot of money. And it's not just, for example, to say, hey, I'm going to average what the market makes, but it's actually to go ahead and beat the market without any of the work. And that's something you don't really hear about. And that's what makes this book actually very rare. Now, when it comes to this secret formula, Tommy, what exactly is it? Stop teasing me. Just tell me what it is, okay? Well, the answer is the blue book just talks about two little pieces of information that make the secret formula. And the idea is you're going to buy stocks for a cheap price. And on top of that, you're going to buy stocks that know exactly how to use their money to make more money on it. That's called return on capital or return on assets. Now, let me go into detail here with the first thing here, okay? You have, for example, return on capital / return on asset. Now, before you blank out and say, Tommy, this is going to be boring, the answer is relax. I'm going to break it down very easily. If you have Walmart, and let's say to open up a Walmart store, it costs $400,000, and every Walmart store makes, for example, $200,000 a year. Well, when you divide those numbers, you get 50%. The return on capital is actually 50%. That means that whenever Walmart goes ahead and invests any money to make more money, they're going to make 50%. And by the way, that is awesome. That is great. And that is very rare. Most companies don't have a massive return on capital like that. Why is this important? Because you want to find a company. Again, this is the first part of the formula, so listen closely. You want to find companies that have a very good return on capital. So you can basically keep growing and growing and growing and making more money from their earnings. Not, for example, you don't want to look for a company where, yeah, they might invest $400K into a store, but they might only make a few $1,000s. Let's say 2.5%. That's not that great. That actually sucks. And inflation eats it all up. That's not what you want. However, the second part of this formula is finding, for example, bargain stocks. Now, the way he uses the formula to actually find these bargain stocks, and by the way, by bargain, I mean something that's selling for less than it's actually worth. And whenever you're investing into the stock market, you know that basically the stock market is a little crazy. Some days it can be very high, some days it can be very low, but in reality, over the long term, the market is going to tell you the truth, okay? However, what he's interested in finding for the second part is basically finding a company with an above average yield on earnings. Now, Tommy, this sounds complicated. What does this mean? Yield on earnings, never heard it before. The answer is it goes a little deep, but again, I'm going to break it down so everyone watching this video can basically understand it before I show you the formula step by step. You want to wait for that, okay? But the idea is, again, let's say Walmart. Walmart wants to go public. So they issue out 1 million shares, okay? Sorry for this current. There's breeze in here. There's no AC. I'm hot, so I need the current. So if you're distracted, I'm sorry. But the idea is Walmart wants to go public. They issue out 1 million shares. That's called outstanding shares. Those are the shares that you're able to buy. Usually, they retain like 50%. So that might be, for example, like 500,000 shares for themselves. Don't get confused. That doesn't matter, okay? But there's 1 million shares, and the market value of those shares is basically $12. What's the value of Walmart? 1 million times $12 is 12 million. That's the market cap of Walmart. There you go. Now you know something new. But then you want to find out exactly what the earning yield actually is, right? And also, what is the earnings per share, EPS, right? The idea is, well, here's what you want to know. There are 1 million shares, and Walmart showed me in their income statement, hey, Tommy, we made $6 million in revenue, but after taxes, after paying employees, after all the fees, paying management, and all the other stuff, we only netted around 1.2 million. So if I divide 1 million by 1.2 million, what does that give me? That gives me $1.20. So meaning, for every share that you have of Walmart, you're going to earn around $1.20 on it. That's the idea. So if you want to get the yield, what do? You divide the earnings per share divided by the price, and that gives you 10% in this case, which shows you, hey, my earnings per share are 10%. And earning 10% on a share is amazing, because if you go to a bank, they're going to give you 1%. Ha, I'm kidding. Maybe like 0.01%. If you go to a bond right now, it is trash. It is not good. Treasury bonds are garbage. So you're not really going to earn any money whatsoever. You get it? So basically, making 10% is above average. It's actually an awesome return. So those are the two main pieces of the formula. A company with a high return on its capital, a company with a high earnings yield, which usually points to a company selling for cheap, that has a competitive edge, that also maybe has a good product, a good service, good management, and it's basically an average, okay? Because if you buy these companies in bulk per se, you're bound to get some companies there that are doing great stuff. That's the idea of the formula. So what you want to do is, again, having said this, this is very important here, so listen closely. You want to rank these companies. You want to find the companies that have, for example, the highest return on their capital or assets. That's one ranking. And also rank them based on, for example, the highest earning yield. And then you combine them to find what the top rank is there. Don't worry, you don't have to do this. I have a whole website for this stuff, but that's the idea. So once you get this entire thing, you pick those companies, and that's what you call the magic formula. Again, if you're following me so far, again, this mystery blue book is interesting because up to now, if you're still watching this video, it still sounds like BS, but it's not BS because he shows all the facts here. So let's move on to the next thing. Now, here's the next thing. How does this magic formula actually look if you actually use it in the real world? Well, here's what they don't tell you until later in the book, okay? And by the way, keep following here because this gets interesting. You're not actually going to use this formula to pick, for example, the top 2-3 stocks, because what you're looking for is to use this formula to accumulate your own little index and get like the average investment. So you actually want to buy 20 to 30 stocks. Now, don't worry. You don't have to buy them all at once. You buy 5 to 7 every few months or so. And on top of that, you only hold them for around 1 year or a little bit more or a little bit less. Now, here's how it works in the real world. So I would be using this formula to find the investments, to pick them out, buy 5 or 7 of them, but then also the losers after 1 year, I'm going to sell them before the 1 year period is over. That way I can claim them as a loss on my taxes. That saves me money, okay? But the winners, I'm going to wait a few days after the 1 year period. That way I can get long-term capital gains and be taxed around 15% or so, and that's about it. Also saves me money in taxes. However, if you have a retirement account and you're using this magic formula, the idea is you don't have to worry about anything. But if you're using a taxable account, obviously you got to make adjustments here to save a lot of money on taxes. So the rule is, if you buy an investment and you wait more than 1 year, that's long-term capital gains. But the problem is that if there's a loser, you want to wait less than the year so you can actually claim it on your taxes for that year. If it's basically a winner, you wait a little longer. So basically, you can get long-term capital gains tax, which is basically a lot lower than short-term capital gains. So that money gets grabbed and put in, for example, into your ordinary income, which is usually a lot higher than long-term capital gains tax. So far, guys, I gave you investment advice, tax advice, and also a few funny jokes. No one's laughing, but they're still funny, okay? But that's how this formula will look in the real world. However, here's also an interesting fact, because although the formula showed you in that statistic whole table, hey, you outperform the market. You will outperform the market. And usually the book gives you even more examples of how this whole thing works, showing you time and time again, you get to outperform the market. However, there are times where you might lose money for 3 years consecutively, or 2 years, or 4 years. So the only way this formula works is, I joke not, this is serious. The author says this, you have to believe in it, okay? And whenever I hear those words when it comes to money, you gotta believe this works. You know, but in everything, there is trust. When I'm investing the way I'm investing, I trust the market over the long term will grow, and that's why I index, right? So same thing applies here. You gotta believe this formula works, and that's why it's so important you dive into this book and actually read it from completely to get why everything makes sense and why things work the way it works. Now, that's the fundamental of how this works in the real world. However, let me show you how to actually do it right here, right now. But overall, the first step is you want to go to Google, type in magic formula investing. You click it. Now, one thing is this is right here a free tool. However, to use it, you got to sign in and you actually have to have an account. To make an account, it is free. Don't use a fake email because you need to confirm it and verify and all that stuff. So make sure you use a real email or one you rarely use. I don't care. Now, once you're here, step 2 is you want to insert your market cap. Now remember, market cap just basically means how much is the company worth? Remember, like Walmart issued out 1 million shares. It's worth $12 per share. That means $12 million overall is the value, or the to buy the whole company, whatever it is. This is it right here. So if you want to buy companies that are $50 million or less, or $100 million or less, $200 million or less, or $1 billion or less, the idea is you put it in here. Now, obviously, if you're buying something that's $50 million, you're going to get a lot smaller companies that usually, guess what, they're a little more riskier, right? Or 100 million, a little more riskier. But $1 billion, it might be like more well-known companies that are basically not really that much risky. But every company is risky. Everything's involved with some risk here, right? Okay, so you want to go here. No, go to welcome, because welcome is just this. You want to go right here where it says stock screener. As you can see, this is my account, so don't try to take my account or whatever. And you go right here and you type in, hey, 1,000 equals, for example, 1 billion, okay? That's what I'm looking for right here. You can either pick between 30 or 50 of these stocks. I'm going to click 50, and then you click, for example, get stocks, okay? That is basically step 1, go to the website. Step 2 is select your market cap and then pick the amount of investments you actually want. And right here, basically, the investments you're actually going to go ahead and pick out and actually buy. Which ones do you want to buy? Is usually the top rank ones. So 1, 2, 3, 4, 5, 6, 7, 8. Okay, these are the top ones. And by the way, you might recognize some. Okay, you might see here Best Buy, Bloomin' Brands, Buckle, Dell Technology, Dickey Sporting Goods. You might see a lot of popular companies here. Even Foot Locker is here, right? So it's not just like, oh, these are random small companies with a lot of risk. No, it's also well-known companies here also. Now, what do you do next? Step 3 is follow the instructions for the top rank list. So obviously, the top rank list is going to be this. You want to take a look at this. Step 4 is you want to buy 5 to 7 stocks that are top rank. And obviously, your goal is to get to 20 to 30, but you're not going to do it all at once, because that's also a way to kind of like dollar cost average this whole thing, which is actually very interesting when you think about it. But you want to pick 5 to 7 of them. So you might say, hey, I'm gonna go with 1, 2, 3, 4, 5, 6, 7. These are the top ones right here. Or you might want to say, I want to pick 1, 2, 3, 4, 5, 7, and I also want Dell and Dickies because I know those companies. But that's not what the rules say, so you are doing it on your own way or whatever. So you pick the 7, and then you go, for example, to your investment platform, your broker, and you go ahead and you buy these companies, okay? But obviously, the idea is, if you're gonna buy 5 to 7, step 4 here, right, is the ones you're actually gonna pick out to actually buy. The idea is you're only going to be putting around like 33% of the money you have to actually invest. So you're not going to put all the money you have to invest, because obviously your goal is to get to 30 stocks and you only have 5 to 7 right now. So you invest with 33% to 20% of the money you have available for investing. You buy these stocks, and by the way, you can use M1 Finance to buy, for example, little fractional shares into these stocks automatically, and then boom, you got it. You can use Robinhood. You can use, what other apps are there? Like, I just really use M1 Finance, okay? But that's really about it, okay? And once you pick those 5 to 7 investments, you repeat step 4 every 2 to 3 months. So every 2 to 3 months, obviously, you go back to the website, you pick another 5 to 7, and you basically add it to your portfolio. That's the idea. And the idea is you repeat this over and over again until you get up to 20 to 30 stocks, and that's gonna take you around 9 to 10 months. Okay, now step 6 is gonna be, you're gonna want to sell the losers a few years before the 1-year period is over to save money on taxes, and you're gonna want to sell the winners a few days after the 1-year period to save money on taxes also. With those proceeds and any new money you're gonna invest back into it, the idea is you go back to the list and you pick some investments to actually buy again. You rinsing and repeating, rinsing and repeating, rinsing and repeating. That's the idea. Now, step 7 is continue this for the next 3 to 5 years. And whether you're making money or losing money, don't stop doing it. Because again, the magic formula only works as long as you're actually doing it, okay? So when he used an example in the book, it was 5 to 10 to 17 years. He actually used a 17-year example and also a 10-year example. So it takes a long time. And step 8, the final step is, okay, feel free to write the author a letter after 17 years if it actually does work. But that's the whole formula. That's the magic formula. And it's fairly easy to make it work. And it's fairly easy for even a 6th grader to actually understand. But if you're like me, when I was in 6th grade, I could barely read. So if you have questions, go ahead and comment down below questions, and I'll do my best to answer all the questions that you actually have. Now, you're probably wondering, Tommy, I know you, okay? You're a long-term guy, and you invest for the long term. So are you gonna do this entire strategy, the magic formula strategy, where you focus just on return on capital, return on assets, or for example, also focus on the yield on the earnings, okay? The idea is this, okay? When you take a look at this thing and you go into this book with an open mind, which is what I try to do, I'm very hesitant to open my mind to nonsense, but this book was actually pretty solid, honestly. It kind of shows you a lot of areas where this actually does make sense. When you look at it, it's kind of creating your own little index fund in a way, right? Take your own little index fund and you're basically following this strategy and doing it over and over again, rinse and repeat, and that's the overall goal. However, me personally, okay, you gotta know the type of investor you actually are. The author says, hey, most people have no business picking individual stocks in the first place. So that's why this right here is not really picking individual stocks. In reality, you're making your own little index fund / mutual fund, okay? However, for me personally, I would not be able to sleep well at night knowing that this is the way I'm investing. So that's just me. So I'm not gonna do this with the majority of my money. I'm not gonna follow the secret formula, following a computer on the internet. I'm just being honest, okay? But I could see a way where I could follow my 90 to 10% rule or my 80 to 10% rule. What is that, Tommy? It means that, hey, all the facts are in this book. It shows that, hey, it works. But it's not just that it works. You want to follow something that's actually possible. I could tell you, hey, it works to restrict yourself to 500 calories a day, don't eat anything, exercise like crazy, you're gonna lose weight. But can you sustain that? The answer is probably not. So although this works, you wanna know exactly the type of investor you actually are. For me, it won't work. I know myself. But I can say, hey, I'm gonna put 80% to 90% of my money into my boring stuff, right? The stuff that I know for sure is gonna work. And the other 10% or 20% into this portfolio that might work in the future, long term, gonna give me some money, yes, but this way I don't really gotta worry about my retirement being in influx. That's the idea. So that's all I have to say for this video. That is the magic formula, and that's how this works. Now, yes, don't worry. Of course, I'm gonna tell you the book right here, okay? Now, this book was written by, let me get his name, by Joel Greenblatt, okay? And this right here is the actual book. The little book that beats the market. And I bought this book because it was very similar to basically the little book about common sense investing by John C. Bogle. I was like, this is so cool, it's so similar, right? And this is the book right here, and boom, if you want to get it right there, like there you go. There you go, you see? A little book that beats the market. But that's about it, guys. That's how the secret formula basically works and how you can basically do it for free. And by the way, one last thing is, if you're going to be using, for example, another screener, just focus on return on assets and focus on a P ratio of no more than 5. I mean, no less than 5 and no more than 10 to 15 or so. That's the major differences right there. But again, that's that, guys. And one thing I would do is you can use this formula in a sense to find yourself cheap, undervalued stocks in a sense that you can basically explore and do your whole analysis and research stuff and then pick them correctly without just guessing and so on. But obviously, in the long-term game, if you are a very good stock picker, you're going to beat everyone. If you are just indexing, then you're obviously just going to get the average. If you're doing mutual fund, you might do good, but most of the time you don't do good. If you're doing a hedge fund, it's just very expensive. If you're doing, for example, this formula, it's obviously a little bit more risky and more like volatile formula, but the facts show that it does work. That's the idea that I found in this book right here. Thanks for watching, guys. Comment down below any questions. I hope this video actually helped you. And yeah, no clickbait. It's actually a way to get a computer to pick your investments for you and show that it outperformed the market and got over 30%, 30.8% in 17 years to be exact. To me, that's crazy. Thanks for watching. Like, subscribe, hit the bell so you're notified. Comment down below any questions. Up here is another video on investing, and up here is my face. Click and subscribe, and long-term team officially